Good afternoon, everybody, and welcome to TradeStation. This is Michael Burke. I head up client education here at TradeStation, and this is another edition of our Futures Trading Series sponsored by the CME. And our guest speaker today is Dan Gramza, and we'll get to Dan in just a moment. The following presentation is for educational purposes only. All of the symbols and trading ideas discussed by the instructor are for demonstration purposes and are not recommendations. Active trading is not suitable for everybody. Futures trading, doubly so. Please take a look at the disclosure information that I'm about to push into the chat, and you can find additional disclosure information on the TradeStation website. We have a masterclass coming up in Plantation, Florida, the end of March. This is a deep dive into everything TradeStation, from advanced platform features to strategy backtesting to learning how to write your own indicators and trading strategies. If you have 5 days to really jumpstart your trading and your utilization of the TradeStation platform, this is the course for you. Lots of fun things happen during the week. We have lunch and learn guest speakers from the CME and the CBOE. Professional traders come in. So if you really want to take your experience with TradeStation to that next level, consider signing up and joining us the last week in March for Masterclass. So today we're joined by Dan Gramza. Dan is president of Gramza Capital Management. Dan is one of the foremost authorities that I know on the futures market. He's an incredible technical analyst. He can really talk about anything, and it is always great to have him here with us. Dan, I'm going to turn it over to you. Thanks for joining us.
Great. Thank you, Mike. Hello, everyone. Great with you. So many exciting things going on. You can see right here where it says daily market commentary. I do a excuse me, I do a daily video at the CME. In fact, I recorded it today. It's usually on Mondays. It's called Market of the Week, where we select one market and talk about my bullish levels, my bearish levels, and the magnitude change that we're looking for. In other words, the challenge to the trade that it has to overcome. Today we talked about the NASDAQ market, so it may be something to check out. Plus, there's a lot of other information that's available, other commentary from other people at the CME group. And this Trader's Insight, this website that you're seeing there, is something you may want to look as a reference. I also want to mention too, and you're probably sensitive to this if you're here today, and that is, TradeStation has such a wealth of information. So it's a place that you can go to every day and find information about the market. So please take advantage of that as well. I also provide a free daily commentary at dangramza.com. And we look at 22 different markets, my bullish and bearish levels. It's a way to see how someone's approaching the futures markets and how they're trying to assess what's going on. So that's a little background about that. Let's move right along here. Craig's not going to be able to join us today. My background, I come from a floor perspective, so that kind of colors how I look at the market and how the markets kind of fit together, how these pieces do fit together. Because when you and I see markets changing, like today, and like you and I are going to look at a little bit later on, we're going to look at a variety of markets, including a closer look, obviously, at metals. But money, I kind of think of sloshes in between these different markets. So when the stock market is weaker, some other market may be increasing, or vice versa. So what are the clues that you and I can look for that we see this intermarket dynamic? And where do metals fit in? Are metals doing what they should be doing today? And that's what you and I are going to be looking at. But first, we're going to look at some fundamentals. The one thing that's kind of new for me is this item right down here that I just passed this along. We just last week received our third security patent. It was issued, and those 3 patents there are on the securitization of diamonds. And so we've had this one patent out there pending for a long time, and that finally came through. So that was exciting news. Alrighty, let's get started. And kind of an overview of production. You know, gold mining is a global business with operations on every continent except Antarctica. Isn't that interesting? And that's a change. That's a new thing. When we think about where does gold come from, and the only reason we care is that we want to make sure if there's an issue in some part of the world that's a major source of something, we want to be aware of that because that'll affect things fundamentally. So for example, in 1970, South Africa produced roughly 2/3 of all production with an annual mine output around 1,000 tons. This has since diminished to 168 tons in 2014. Mine supply has become less geographically concentrated as more countries have become gold producers. So we got diversified sources. And here's the thing that I think sometimes people fail to realize, or maybe just don't realize. It takes about 10 years to develop a gold mining project to production. So for a major mine to come online, it's not a small process at all, which also means for you and I that new supply, major supply, even though it may be found, we're not going to see the impact of that for a while. So it says something about the sensitivity of supply to be adjusted with demands for gold. Now, here's my question for you. What country do you think produces the most gold? Just type it in there. What do you think? So when you think of gold, you'd say, geez, you know, I think of so-and-so as a major producer of gold. Canada. Hey, Ronald, that's a good guess, actually, because Canada does have a lot of gold up there, and they are a source of gold. I think that's a good one. Michael, South Pacific. Interesting. We're going to talk about, well, Australia. China. Brian, China. Ooh. Brian, I think you get the gold star in this one because let's take a look at this. China, 462 tons. Now, this is a little out of date, about a year or so, but maybe more than that. But these positions of these countries haven't changed. South Africa, see, Gene? I think, to me, that would have been the first one I would have thought of. But it's China, Australia, Russia, United States. So we're number 4. Peru, South Africa. See, look at how South Africa, from number 1 to where it is right now. Isn't that interesting, Gene? I don't know. And Canada. See, Ronald, you said Canada. Canada's up here. Mexico, Ghana. I just was talking with a fella this past weekend in New York, and he's from Ghana. And I went to Ghana a few years ago for the Ghanaian government, actually. And what we looked at were hedging techniques for the Ghanaian dollar, for their currency, I should say. For crude oil production, they also produce crude oil and gold. And one of their major resources there is cocoa, because they're in that temperate zone. Now, if you look at cocoa, it's only produced in a band not too far from the equator. If you look at cocoa production, where here we don't have that geographic limitation when it comes to gold. Uses of gold, primary use, jewelry, about 60 to 78% of gold consumed each year is for jewelry. If we look at gold uses, again, it's a vital industrial commodity, excellent conductor of electricity, extremely resistant to corrosion, one of the most chemically stable elements, easy to work, critically important in electronics. And you know, one thing, I don't have it in here, but there is something too that I think we should think about. There's about 50 cents of gold. About 1/3 of gold supply comes from recycled gold. So it's another source of supply that we have. But what's interesting to me is about in a cell phone. there's about 50 cents worth of gold. And we go through about 2 billion cell phones every 2 years. And we basically don't recycle all that gold. So it's the one thing that we have that we're not bringing that gold back into our supply chain. So it's kind of interesting. We'll see what happens in the future. Now, what's behind the gold movement? Gold is classified as an alternative investment, a safe haven investment, an inflation hedge, U.S. dollar weakness, U.S. recession. People go to the gold market. Central bank activity. You know, if we just look at those, I mean, you and I could think about it like right now. Do we need a safe haven investment right now? And we have a lot of geopolitical stuff going on, and maybe some of those could trigger it. Inflation. In fact, Mike and I were talking about inflation before we started today. Do we have inflation? Not only here, but many of the major developing economies. No. All right, well, what about the dollar getting weaker? A weaker dollar, people get concerned about many other things, and gold is one of the places that money can flow towards. Do we have a super weak dollar? Well, you and I will take a peek at that in just a minute. U.S. recession? No. Our economy's kind of doing okay. Central bank activity. Since 2009, we've seen central banks positioning themselves differently than they have in the past. Like, do you remember, gosh, I think it might have been late 90s, when Bank of England was decreasing their inventory and the impact it had on the gold market then. You know, when you think about it, why does a central bank even have gold? We don't use gold anymore to back a currency. Last currency that used gold for backing was the Swissy, and that was 1999. So we don't do that. I was with a few people I know at the Bundesbank in Germany a few years ago now, and we were talking about this issue. I wasn't there for work. I was there to visit a friend, and he brought along an economist, and we're having lunch. And what I asked him was, how much central bank gold is necessary? I mean, does it back any currency? No. So what is the amount of gold then that creates a psychological comfort to the population of the country? Is that why a central bank has gold? Or do they feel that if the world collapses, they're going to have an asset that has value? There's no answer to that, by the way, and they didn't have an answer. I didn't expect one, but it's an interesting topic of where central banks fit in. And also it reflects where the country's perception may be of the value of holding gold. You and I will take a look at that. So influencing factors, consumer gold purchases in 2015. I couldn't get an update on this, but look at China. Oh my God, look at China and India. What a change. And look at how much they consume of gold compared to the United States. And I kind of think we buy a lot of gold here. These numbers, even though they're a couple years old, these really haven't changed in terms of relationship. And China passed India a few years ago in terms of being the #1 consumer of gold. India traditionally, gosh, I can't remember how many years India was #1. And we'll talk about what's happening in China that's caused this shift in gold demand. So what is behind it? Let's start with China. Gold's expanding, China's expanding wealth. It has made the countries the world's largest gold buyers we've been talking about, surpassing India as imports reached an all-time high. New outlets for Chinese to buy gold. This is a biggie. And where it fits in, I think, in terms of the general thought process. If we now have gold, let's talk about the Chinese New Year. Now, traditionally, I would give you a red envelope with some money in it, and you give me one with some money in it, all right? So this red envelope would have money. And one of the things that changed a few years ago was gold. Some people were putting gold in that envelope. Many banks and providences are selling gold bars. That's a new one. So if I now have disposable income and I want to have some security in my wealth, that could be a place I would go. It's also what we see in India traditionally. Many Chinese who've had limited access to gold in the past think it's a good idea to have a bar or two as a long-term investment. That is a game changer. Access, capital, or maybe capital number one, got to have some money to buy it, and you have a place that you can now buy it. It doesn't take some kind of special thing that you'll never have access to. Let's talk about China also in a broader point of view. And when you hear about certain markets, and some of which we're going to be talking about today, let's look down here at gold. China, around 23 to 25% of gold is what it consumes. And you look at the green area there, and you can see generally where China kind of fits in. We have aluminum. We're not going to be talking so much about that today. Nickel. China's a huge consumer of those areas. Steel, lead. And if we think about steel, it makes me think of iron ore, another metal, and that makes me think of our friends down in Australia. Australia is the world's largest exporter of iron ore, and their major customer is China. So China is the #1 customer of Australia. Japan's #2, United States #3, Korea's #4. And nickel, another important element, about 50% of it. Here's one that we're going to talk about today, though, later on, and that's copper. Around 50% of copper consumption is China. Actually, China, US, and Germany are the top 3. But we'll take a look at that. I just wanted to give you a feel for where China fits in terms of its consumption pattern in general for these different markets. I think it's really interesting because it tells you and me something about whether it matters when we hear news about manufacturing in China. Because that goes back to these base metals. Central banks, look at the reserves, gold reserves of central banks. See how it was going down? They were decreasing gold reserves, and the trend now continues to the upside. And what's interesting also is who's participating. As of February 5th, 2015, the top 4 central banks holding of gold, reserve gold, account for more than 50% of all gold reserves. And again, why? Top holders of gold: United States, Germany, Italy, France. You see Russia, Switzerland, Netherlands, India, and Turkey. But that's part of the picture. Who holds a big chunk of world's gold? Well, these countries do, but it's not the full story. If you look, let me just go back to that for a minute. I realize I didn't put it in here, but a country like, if you look at Kazakhstan, that country, it's so impressive. It has done so much in terms of growth, economic growth, its development. It's really impressive. They're also a country that if you look at the consumption of gold, I'm talking about central banks now, has increased dramatically there. They're not on this list, they're not that big, but it's an example of what we're seeing happening globally. Now let's talk about another issue when it comes to gold, and that's holidays. Now this is my look at on gold because I think it's something that you and I should be sensitive to. Because with any product, with any market, one of the things we want to ask ourselves is, when do you and I see the big moves? Is it once a month? Is it the first week of the month because of fundamentals? which may be driving it? Is it seasonal because of holidays like I have here? Well, when I think about gold, you and I have some biggies that happen at the last quarter. Ramadan, Diwali, holy Toledo, that's an amazing event that happens globally, just like Ramadan. Christmas, and then again the Chinese New Year. The reason I'm mentioning these is that typically in the past, it doesn't happen every year, but typically in the past, September to February, we have a tendency to have stronger gold prices. So I think it's something that you and I want to pay attention to. If you want to follow the gold market, pay some attention to that last quarter and the beginning of the next year. See if you're seeing some strengthening in there. That may be something that you and I could take advantage of. So, what are our options for trading gold? We could buy gold stocks, we could buy ETFs, and we could buy futures. Gold stocks, a bit tricky, because if I think about mining stocks, you look at BHP, that's the world's largest mining company. Well, they should mine gold. They do mine gold. And they're the largest diamond miner, in fact, as well as a lot of other things. So it's a bit tricky if you and I want to pure play into that market. ETFs, GLD is the symbol of an ETF that is a gold ETF. That one uses gold to back it. It's kind of an unusual thing. It's one of the first ETFs to do that. That's a possibility, but I don't know. There are some challenges to that. One, my cost to acquire an ETF compared to futures. I have more leverage with futures. It trades 24 hours a day. I get tax benefits with futures. Well, I'm sorry. I'm just rambling on here. Let's take a look at a few things. Whether they're regulated 24-hour tax benefits and leverage. Regulated? Yes, they're all regulated. SEC for stocks and ETF futures, CFTC. 24-hour trading, no for stocks and ETF, yes for futures. And see, I got to tell you, I kind of think that's a big deal because it allows us to manage our risk. If I buy gold and put a stop below a certain level, that stop is working when I go to sleep. Or let's say that you and I wake up and we see, because when I look at any futures market, we go to bed seeing what, I'm in Chicago. I go to bed seeing what Asia's doing, and I wake up seeing what Europe is doing. So let's say that you're in a time zone where you're looking, let's say the US, and we see in the morning that there's things happening overnight. Maybe it's Brexit, maybe it's something else, but we feel the market's going to react to it. Well, with futures, we can react to it. If there's dividend announcements or something that happens after the stock market close, with futures, you and I can react to it. So that 24 hours, I think, can be a significant thing. A tax benefits. Here's the deal on that. I'm not an accountant, but here's what I can tell you. If you don't hold stocks, and I'm sure you know this too, if you don't hold stocks or ETFs beyond a year, there are no tax benefits. Any profits or loss, it's going to be short term. With futures, there's some tax benefits, and here's what you need to know. And find out more about this. It's considered a 1256 contract. But if I make $1,000 on the ETF and I make $1,000 on futures, the GC is the contract symbol. After taxes, and I'm a U.S. citizen, I keep more of that profit because of the tax benefits. Leverage. Well, they all have leverage. I can buy stocks and ETF on margin. I put up 50%, and TradeStation gives us a loan for 50%. So yes, they have margin. Futures, the amount that we have to put up ranges from 3% to maybe 15% on the highs. It depends on the volatility of the market that determines the margin amount, but it's going to be less the amount of capital than the amount of capital I need for stocks and ETFs. So let's talk about the gold contracts. There's three choices that you and I can look at. There is a micro gold, which is 1/10 the full size of the contract. There's a mini gold, and then there's the full size contract, a GC. And here's the difference. You got 100 troy ounces for the full size contract, 50 for the mini, and you got 10. See, so it's 1/10 that size. And the price quote, well, if you look at the sides, they're dollars and cents per troy ounce. But here's the deal. It's $10 a cent in gold full-size contract, and it's $1 per ounce for a 1 cent move in the micro. All right, so it's 10 cents is that move, and 10 cents is the move there, but it's the value. I said a penny, I think, a cent. I was thinking crude oil, I guess. It's 10 cents for gold. But see the difference here? It's $1 for the micro, $12.50 for a mini, and for $10 for the gold contract. Here's the deal with that, really. Let's say that you've done your homework, you got your strategy, you want to trade gold, you've back tested it with TradeStation, you feel comfortable and confident about your profitability and your risk management control, and you want to trade gold, and you've never traded it before. Well, a place to consider could be this micro contract, because not only does it affect the tick size, it's also going to affect your margin requirement, which will be a lot less. So your exposure overnight will be less because your tick size in terms of value will be less. So it's something to think about. Now, there's something, since we're talking about this, it's coming up in May. It hasn't been launched yet, but you got to be aware of this one too. Is the CME has a full-size gold, S&P 500 contract. They have an E-mini S&P 500 contract, which you probably know about. Well, check this out. They're going to have a micro contract, which is 1/10 that size. So that's going to be launched in May. So it's coming up. Just want you to be aware of it. Well, gold ETF compared to gold futures. Let's look at that. Now, I have a value of investment of $130,800. So let's say that you and I want to invest $130,800 into gold. That's our allocation. So let's look at what it would take to do the ETF and what it would take to do futures. By the way, I'm not trying to make it sound like ETFs are bad or they're not as good. It's not good or bad. It's just they're two different investment choices. And for you and me, we should be aware of what our investment choices are. So I'll tell you where I got that $130,800. We know that the futures contract 100 troy ounces. The value when I did this was March 13th, and that was 1,308. That's where gold was trading. So all you got to do if you want to find out the value of one gold futures contract is multiply 100 times that number you would see on your screen for the futures. And that is where I got $130,800. So if you're buying that one futures contract, that's what you're going to be getting. That's the value of the investment. Okay. Here's the ETF, here's the futures. The current level, the ETF was trading at 123.56 per share, right, because it trades like a stock. And here's the gold futures price per contract. So we're going to have to figure out how many ETF shares to get. So we're going to take the $130,800 divided by $123.56 per share, and we need 1,059 shares, or one contract for gold futures contract. Minimum tick, well, stocks and ETFs move up and down in 1 penny increments. And over in our gold futures, I have $10 per contract. It's actually $10 per every 10 cents, right? 10 cents is what it moves up and down. And so tick value, I take the number of shares we need times 1 penny, and it's $10.59. And again, over here, it's $10 per tick for the gold futures. So the gold ETF at that price level actually has a higher tick value than futures. Now let's talk about cost. Margin. So I could buy this gold ETF. I put up half the money. TradeStation gives me a loan. That'd be $65,400, right? And I now have exposure to $130,800 of gold. Or gold futures right now is at 3,400. Maintenance is at 3,400. It'd be about 2.6%. Now I want you to know that number I'm showing you for the gold futures. That can fluctuate. It can change. It doesn't change all the time, but it can change. So you and I should be sensitive to that. Now, what does that number mean? First, it has nothing to do with a loan. What it means is if I want to buy one contract or if I want to sell one gold futures contract, that is the amount of money in my account that's allocated to that position per contract. And that's money so if I buy a contract, that 3,400's now allocated to my futures position. I don't have access to that money until I close out that position. And then that money would go back into my account. So margin in futures, if you're not familiar with it, has nothing to do with loan. It is the amount of deposit that you have to that will be allocated to hold a position per contract, whether it's long or short. All right, and that's where this capital efficiency comes into play. It just takes less money to establish a position. Margin interest, yes, when it comes to ETFs, because I got a loan out there. No, when it comes to futures, because there's no loan involved. If short interest, yes, there's some cost to shorting a stock or an ETF. No, with futures, you're not shorting an asset. When you have stock, you're shorting an asset. Therefore, you have to have ownership. And that's why, TradeStation goes out and borrows a stock for us. Well, gold futures, you're not. You're creating a contract. So you want to sell it? Sold. You want to buy it? Buy it. And fund expense, well, ETFs have a fund. And so there is an expense associated with it. Yes for ETF, no for futures. And again, 24 hours. Yes for futures, no for the gold ETF. You can do this comparison like I did with other markets too. You want to do the E-mini S&P 500 compared to SPY, the ETF. You're buying 500 shares of SPY. So you could do that with these other markets. So in other words, what we're saying here, you buy around 1,000 shares of gold, or you buy one futures contract, you have about the same exposure to the market. All right, just something to keep in mind, and it's a way for you to make other comparisons too. All right, now let's talk about silver. Silver has some distinct features too: strength, malleability, and ductility. Electrical and thermal conductivity. Has the highest electrical conductivity, if I could say it, of all metals, even higher than copper. Sensitivity to and high reflectance of light. Ability to endure extreme temperature changes. Pure silver has the highest thermal conductivity. So it's got some unique characteristics. Oh, hey, let's do this again. What country produces the most silver? What do you think? Ronald, Michael, Brian, Gene? Any ideas on this one? Peru. Gene, ooh, that's an interesting one. Peru, Ronald, Mexico. Ooh, Mexico does produce a lot of silver. That's a good one. Yeah, Nan, Mexico too. See, I think Mexico's a good one. Peru is too. I mean, when you think about silver, I think of South America, as a resource for that. Well, let's take a look. Mexico. And who's right below it? Peru. You guys are right on target. Our largest producers of that. Chile is also right up there. And China. Look at the top four here. Mexico, Peru, China, Russia, Australia, Bolivia, Poland, United States, Argentina, right? We go right down the list. Boy, you guys know your metals. All right, pure silver producers are few. 75% of mine production of silver is from mining of zinc, lead, copper, or gold, so it's a byproduct. Uses, batteries, bearings, brazing and soldering, catalyst, in electronics. The contract terms, it's 5,000 troy ounces. It's traded in dollars and cents per troy ounce. Globex trading hours. So, basically from 5 o'clock Sunday night Chicago time to 4 o'clock Chicago time on Friday. And it starts Sunday night Chicago time because that's Monday morning in Asia. Trades in 0.5 of a cent per troy ounce. That's $25. Symbol is SI, right? And it's deliverable. So is gold, by the way. But 98% of the people who trade this in all other futures contracts, they don't go to delivery. They're not buying this to get silver or gold or copper. They're buying this or selling it because they're looking for price movement. Including I deal with a lot of institutions. I don't know anybody who really goes to a marketplace to get delivery. I dealt with a company they're in the United States, and they buy thousands and thousands and thousands of grain contracts for feedlots that they have on a daily basis, really. And they're doing that not because they want that corn or soybean, because they're trying to protect themselves with price change. Well, copper, let's talk about that one. Strength, malleability and ductility, electrical and thermal conductivity. Hey, this is like silver. Sensitivity to and high reflectance of light, ability to endure extreme temperature ranges. If we look at copper in terms of usage, you can see it's just going up to the right. Well, it has continued up to the right. Ooh, you and I should talk about one of the reasons why. Now, let's talk about mines. And really the one that you hear the most about is right down here, and it's in Chile. It's Escondida. I'm probably not pronouncing that right. But anyways, that mine is a big deal, because it's the largest copper mine in the world. Now, not that long ago, and every so often this pops up, is they have a strike. So when you hear about that, it is a big deal. And so you want to be sensitive to that one. And I think something that surprises most people, it did me when I first found out about this a number of years ago, actually. But for the second largest area is Indonesia. Excuse me. In terms of mines, you have the United States and then our friends in Mexico, Chile. So when you hear something about happening in Chile regarding mines, and you've got, 2 out of the top 5 down in Chile, copper is such an interesting marketplace because of that global demand. And something else that's interesting about copper is we don't have a substitute for it. I think I mentioned it. Excuse me, I'm sorry. Major trade flows for copper. All right, so major exporters of refined copper: Chile, Russia, Japan, Australia. Hey, Kazakhstan, remember we were talking about them. And then over on the imports of copper, China, remember they consume about 50%. Germany, United States, and we switch back and forth between Germany and United States in terms of imports. Italy, Taiwan, Turkey. The thing that you want to think about when it comes to China is they've had over 350 million people moving from the farm to cities. I mean, for those of you in the United States, how many cities do you think we have that have over 10 million people? Maybe like New York, right? And LA, I would say. Chicago, maybe if we include the surrounding suburbs, might be above 10 million. China, 15. And the fastest growing cities there are between 3 and 5 million people. So here's what it means, and this is why I think you and I should be sensitive to. China now has new consumers wanting stuff. These new consumers that have moved to the city have disposable income, or some, and they want a refrigerator, stove, maybe things they didn't have in the countryside. So you have huge consumption pattern. And you have to build stuff for those to meet that consumer demand. So you need huge resources. Plus, you got to make stuff that we buy. So the demand for China on resources is significant. So it's a big deal. I mean, it's why down in Chile, they purchased a mountain and they're moving the village. In the Congo, they spent I think it's $35 or $25 million to build some roads. Nice for the people there, they got nice new roads, but those roads are going to be transporting resources. Afghanistan, they have the rights to copper there. They need it. And for us, it's important to realize that there are going to be certain products in the future, certain resources that we may need also. But they may be, trying to not corner the market, but gather as much of those resources as they can. So it's an interesting time, and copper right in the thick of things. So it is considered a critical metal, as I mentioned. It's a lack of substitution. If we run out of copper, well, okay, what do we use? Unfortunately, with today's technology, nothing. The uses of it: electrical wires 60%, roofing and plumbing 20%, industrial machinery 15%. Small part of copper supplies is used in the production of compounds for nutritional supplements and fungicides in agriculture. Building construction, power generation, those transmission lines, electronic product manufacturing, production of industrial machinery and transportation vehicles. Copper wiring and plumbing are integral to the appliances, heating and cooling system, telecommunication links. Copper is an essential component in motors, wiring, radiators, connectors, brakes, and bearings, and used in cars and trucks. Check this out. The average car uses about almost a mile worth of copper wire. The total amount of copper ranges from 44 pounds in small cars to 99 pounds in luxury cars, and in hybrid vehicles or all-electric vehicles, it can be 4 times that amount, 2 to 4 times that amount. So we need copper. The contract size, 25,000 pounds, dollars and cents per pound. In this, Globex trading hours that we talked about. And then down here, they go out 1 further decimal. So you're looking at 1/10,000th of a cent, 0.000305 per pound, and it's $12.50. So 1 full penny in copper is $250. That's another way to think about it. HG is the symbol. Alrighty. Oh, by the way, just like with the other ones, it is deliverable. But again, I don't know anybody takes delivery. Now, market influencing factors when it comes to metals, supply and demand is a logical one. Nyan, you said, what are your thoughts on future spreads? Dan, is it too risky? Oh, I have to tell you, Nyan, it's a very interesting topic. Spreads and futures are very interesting. And are they more risky? I don't know if they're more risky. Now, the exchange feels that they're a little bit less risky because your margin requirement on a future spread is less than it would be if you held the outright underlying contract. I don't necessarily share that view. Spreads can have volatility, and we need to respect that volatility. So if you and I approach it just like we would the underlying, that we do look at risk. We do look at how much this market, based upon what technique gets us in, how much risk do we have to take to maintain the position? If I go back and look at that, I call it a heat factor. So if I understand the risk, if I understand that when I put that spread on, and using this technique, maybe it's moving averages or whatever, RSI or something that gets me into the trade. If I looked how it's performed in the past, does it ever trade against me? And if it does, by how much? So I want to use that as my guideline for risk. So I don't know if it's too risky. I think it's a market that you and I would have to do some homework on. And is there a time when this spread is consistently profitable? There may be. And it could be because of fundamentals. It could be because it's seasonal. So, oh, you're welcome. Just a couple things to think about. Currency impact. You know, these things are in dollars and cents. If I'm a gold producing country, I get paid in dollars. If I'm Ghana, I get paid in dollars and cents. And if I want to keep dollars and I want to flip it to my home currency, and if the dollar's weaker against my home currency, I get less of my home currency. So currency has an impact here. Terrorism, weather and storms, war, geopolitical factors, government regulations, perceptions of supply disruptions. And we see that especially in copper. We hear about a strike down the mine that you and I were talking about in Chile. The copper prices react to it. Did it have an impact on supply? That's what you want to think about. When you hear about a metal moving because of supply issues, is it something that could happen, or is it something that is happening? And there's a gigantic difference, as you know. And that is what we want to be sensitive to here when it comes to perception. Now, you know, let's just look at these right here, like the terrorism, weather, war, geopolitical factors. How do they fit in? They fit in because they create uncertainty. And in times of uncertainty, typically, capital flows towards gold and silver. Because the concept is it holds value. There's some value in that stuff, no matter what happens. But here's something I want you to think about. Do you remember back in 1990, actually the end of 1989 and beginning of 1990, when Saddam Hussein was visiting Kuwait? Do you remember when he invaded? Now, that was a lot of uncertainty of what it meant. It was a lot of uncertainty when the U.S. went in to Kuwait of what was going to happen. Nobody knows. And gold went sideways. It fascinated me. Gold was acting like a base metal instead of a precious metal in times of uncertainty. So, you know, you and I want to be sensitive to that. The expectation is that gold will move in times of uncertainty. It's one of the drivers. So we do want to take a look at it, but it doesn't always do that. Government regulations, a stroke of a pen can change. Actually, look at that. 1972, when President Nixon changed the Brentwood Agreement, when he took the dollar off the gold standard and said, look, here's the deal. Everybody's currency just floats. So whatever your economic situation is in your country, it's going to be reflected in your currency. Stroke of a pen. Hey, Gene, do you think a change in the global default currency from US dollar to euro or US dollars to renminbi move the price of gold? Well, Gene, I got to tell you, I love this question, by the way. But when we think about the global default currency, when you say that, I think we have a ways to go before I think of the U.S. not being the default currency. You know, it's 80% of all transactions. And so it's going to be hard to replace it. But Gene, you may be onto something. Is it possible? If you think about the euro, I mean, euro represents 350 some million consumers, just like the United States, which is why I loved it when they launched the euro, because it forces competition. That's what I was thinking. And as you know, or if you're an American, you know, competition is what drives us, because competition makes us better. And so we got the euro out there, we got the US dollar out there, and so that euro, that large group of consumers for it, could have an impact on it. And then when you talk about China, you know, US dollar to renminbi or the yuan, I have to tell you, you know though, Gene, I think it's going to take a while on that one, because do people have the trust and the confidence in that Chinese currency? I think it'd be a long while before we'd have that comfort that the world would now start using it. Although they would be happy to see that, and they want that. Understandable, but I think it's going to be a while. Now let's go back to your question. Oh, you didn't ask me all that. You said about the move to the price of gold. Here's where I think it would fit in, Gene. It's what would this do if we had this change in a base currency, a change in the global default currency? It would create uncertainty at first, right? Because people think, Jesus, I got to be using the euro now instead of the dollar. So I think it would create uncertainty, which could create demand for gold. And as that uncertainty maybe wanes, it would decrease the demand for gold in that respect. But it wouldn't be surprising to see that. And you know something, Gene? Maybe if that does occur, and who knows, it may be slow enough that we don't see a dramatic change. In other words, the world doesn't say, hey, you know something, right now default currency is going to be euro, that's the deal. It probably won't happen that way. You know, because it's going to be more subtle, I think, than that. So thank you, Gene, for that. William, you just said something here too. I just saw it pop up. I am certainly not a doomsayer, but I hear from a number of companies encouraging self-directed IRA to move to gold because of the dollar to the world and a reference to a loophole in the law that exposes individual cash accounts, IRAs and 401s, annuities, to confiscation from the government and bank function. You know, William, I think you're right. I kind of feel like you do. I'm not a doomsayer on that one. And if I'm that concerned about it, then I probably wouldn't want my gold in the bank, I suppose, maybe a safety deposit box. But, you know, I just don't have that outlet. Here's the thing. You know, William, if that would be the case, what's the motivation for the government to do that? So they can hold all the gold? Okay, and what does that do for the government? You know, one time, we've gone back and forth in the United States, if you look at our history, where gold fits in. You know, one time we had gold and silver notes. We had gold that backed every US dollar. You know, I don't see the motivation to do it. I don't see, what do they gain if they hold all the gold? Well, if they hold all the gold, then you and I don't have any. So we're kind of back where we were before. Santander, you said, can you talk about some trading strategies of gold trading? London Open, can you give some hints on which way gold will move up or down? Okay. If I purchase gold and retain in the safe or repository. Well, you know, William, the idea, I'll finish that because we were starting with that. Yeah, it could, if you and I are concerned about that issue of the government taking involvement in the gold marketplace, then yes, we wouldn't want it in an institution that holds it. But gosh, then you and I got to deal with, if we get enough gold, you know, William, we get enough gold that it's going to have a real impact for you and me in terms of our security. Geez, yeah, that's going to take a chunk of gold probably. Do I insure it? You know, do I put it where? Do I put it in my safety deposit box? You know, that may be one place to put it. Is it important for me to insure it? The tricky bit about gold, it's not really easy to transport. You know, you start getting a few gold bars in your pocket and you're leaning to one side or the other. So, but I think it would take that type of thing, William. Then I think, how much of our capital do we use to do that? I think that's a tricky one. Well, Satinder, you said, how about talking about gold trading strategies? Agreed. Yeah, William, I thought you might feel that way because the way you started your other statement. I can tell you when it comes to trading gold, though, let's talk about that, what we should look for. By the way, what I'm going to tell you is not only for gold, but if you look at institutional players, I see a lot of institutional desks around the world. And there's a couple things that you'll see in an institutional desk as you come towards another time zone. And what that is that people have a tendency to even up. You know, most people think that institutions, you know, have a strong opinion as they go into another time zone. That's not always the case. I think about banks in Australia or actually in Europe. You know, some trading desk, it depends on the risk manager also and the position the bank wants to maintain. So if we want to have a certain amount of exposure to gold and maintain that around the globe, well, then we're going to come in with a certain inventory to other time zones. When it comes to gold itself, my expectation is that people even up a bit. They lighten the load as they come into the next time zone. So I think that's one thing that you and I can think about. But does it give us a hint about which way gold will move, which you also asked about as well? I don't think necessarily. So in other words, if we looked at a market that we're seeing buying coming in as we go into the close, if that's true, if it's true that buyers are coming into this market as we go into the time zone change, then you should see it almost immediately when the other time zones open. And I would say that's a clue. Because if that paper is there, if the institution is holding the position, if the marketplace is adding to a position, and I'll show you some things that you and I can look at that may give us a clue, then we should see follow through right afterwards, unless you're looking at a number that's going to come out and people are waiting for that number. And so what we can see then is how are people positioning themselves before that number. Global demand from emerging nations, refinery or mine fires or shutdowns. By the way, when you hear about a mine fire, is it a major miner that's having the fire? Because those do pop up once in a while, unfortunately. When it comes to futures, easy access, one central marketplace, supplements and diversifies your investments. They are highly liquid and tight bid-ask spreads, especially in the ones you and I are talking about. Tax advantages we talked about. Leverage we talked about. Open and transparent pricing. Here's the deal on that. They use this software called Globex, and it's what the CME created because these markets are traded on CME. And the way it works is when you and I put an order in at TradeStation, TradeStation instantly routes that to Globex. Globex is a software program that matches the buy and sell orders. Here's the big deal, and that's why you say here open and transparent pricing, and this is a big deal, is that if I was going to buy one contract and you're going to buy 1,000, so I got one gold crack I want to buy, I push my button, then you push your button an instant right after me. So my order's in front of you. Who gets filled first? I do. There's no order preferencing. So it's transparent pricing because what you and I see on TradeStation is the market. I don't have to worry about other markets out there. and it's very open in terms of fairness. So that's what's referred to there. Segregated accounts, it means our money doesn't touch each other, and virtually 24 hours of trading. You and I talked about that too. That, as you know, when the closing price is above the open, I have this as green. The traditional color, by the way, is red. That's called the body of the candle. I think it represents buyers coming into the market. On the other side, when the closing price is below the opening price, I think that represents sellers coming into the market. And the reason I'm telling you this is because this is what I would see on the floor. You and I don't have to be on the floor anymore, but it's based upon how order flow comes into a market. Market makers on the other side are there to take the other side of your trade. That's why you have a bid and an offer. That bid and an offer shows you what the market maker is willing to do. They're willing to buy it at 5 and they're willing to sell it at 6. And because of that, you and I know we have a market maker. When a market maker takes the other side of the trade, they're instantly trying to get out. They sell it to you at 6, they want to buy it at 5. They do not cause a long-term trend. Order flow does. The person who bought that contract does. You and me adding to that flow. The highs and lows match the top and bottom of the candle. If the high is above the body of the candle, I think that's called a shadow, as many of you know. I think it represents sellers at higher prices and it represents buyers at lower prices. The sides of the shadows gives us an idea of what I consider rejection. Size of the body tells us something about level of interest. Are the bodies bigger or are the bodies smaller? The level of enthusiasm that we could look for in a market. Now, let's do this. I'm going to, oh, wait a minute. Did I do the right thing here? Hold on one sec. Yeah. The next program coming up is going to be April 9th, and that's going to be on energy. Oh, that's another market. Holy Toledo. Is there a lot going on with that or not? Well, let me grab this here. There we go. And I think in just a minute, you should see right now a bunch of charts. Now, those charts are daily charts. And these are the charts that markets that I go through at the dangramza.com website. And again, it's free. Just take a peek at that. Another reference for you. But we have stock market above. We got S&P, NASDAQ, Dow, and over here, Russell. And then we have the currencies, Euro, Swissy, Japanese yen, middle row, Aussie dollar, British pound, Canadian dollar. 5-year notes, yield curve now. 5-year notes, 10-year notes, 30-year bonds. Then gold, ooh, gold. Silver, copper, crude oil, nat gas, soybeans, corn, and wheat. All right, that's what you're looking at. Now, just take a second, let your eye kind of skim across those charts. And are they all moving in the same direction prior to today? How many do you see with the red candle for today? Now, as you're looking at that, there's a few things that I think we should think about. What creates the beliefs that people are expressing today, right? That's what you and I look at here. When we look at these charts, we're looking at the beliefs of the people who are coming to trade these markets. Well, let's talk about our friends in China. China industrial output increased 5.3%, the slowest expansion in 17 years. But China has increased their investments. If they look at their fast-tracking road and rail projects, China retail sales increased 8.2%, so people are spending money. But right now, we also heard today that there's not going to be a meeting with China on tariffs. Trump has said he's not in a hurry. He wants to get the job done right. And that changed expectations of the market. We've seen some softness in manufacturing in China. These tariffs have had an impact. And, you know, if you look at the UK, we got to talk about them because that was out there. UK, May, she gets her, well, she gets Parliament backing to delay the Brexit date. Boy, that's another complicated thing you and I could talk about. Holy Toledo. And U.S. jobless claims increased to a 4-week high to 229,000. They were expecting 225,000. U.S. import prices increased 0.6%. So some of those pieces of information we're seeing reflected in these charts. So starting on the top, we're seeing weaker stock market. We're seeing weaker currencies. Now, in these currencies, they're all dollar-based. So euro, this EC means the euro. It's the euro US dollars. They just don't put the USD up there. All right, but that it's understood. So what that means is if this price goes down, if you see a red candle, it means the euro is getting cheaper because the number that you see on the side here is the cost in US dollars of 1 euro. All right, so when it's going down, it went from $1.13 to, let's say, $1.12. So if I went into the bank on this day and said, I'd like to buy 1 euro, and they say, sure, $1.13. And I come back later in the day and say, I'd like to buy another euro. They say, sure, it's $1.12. And I say, son of a gun, it's got cheaper. In other words, the US dollar got stronger. In times of uncertainty, capital oftentimes flows towards the US dollar. It also flows towards Japanese yen. We're not seeing that today. So what have you seen here in these currencies? Also our friends down here in Australia, the British pound, you know, there's uncertainty in the British pound. Who in the heck knows what's going to happen? They're trying to sort it out. May is looking for a 2-month extension beyond to figure things out. By the way, under Article 50, just so you know, they could ask for up to 2 years. Under Article 50, you have 2 years once you make the announcement to leave. If you don't at that point, they have the ability to go up for another 2 years if they get EU approval. And I kind of wonder if some members of the UK Parliament realize that. They may want an extension, but you know, we've seen Germany and France and the EU saying, yeah, we'll give you some more time. But we'll see what happens there. So the British pound, it's normal. And look at the Canadian dollar. It's got a red candle. So the US dollar was stronger. The US dollar was stronger against those 6 currencies. And the notes and the yield curve, let's do it that way, it's gotten weaker. Now, here's the thing. I like that because it tells us that money is flowing away from interest rates. And typically it would flow towards the stock indexes up here on top. We're not seeing that. So in my opinion, something has to give. Either the stock market gets stronger, which I lean towards that, and I'd look for further weakness here in the interest rate markets. Ooh, what about gold? Well, if there's so much uncertainty out there in the stock market, well, do we have a weaker dollar? No, we don't have a weaker dollar. We got a stronger dollar based upon what we're seeing here right now. Okay. Inflation. No, not really. No, not much inflation. So we're not seeing the excuses because that's what I think gold and silver are. They're excuse markets. They're driven by some reason. You know, it's not like other markets where we look at relationships. They need an excuse to do something. So give them some uncertainty, and you would expect firmer prices. Now, in my daily video, I mentioned yesterday on silver to be cautious about that. So let me ask you a question here. Let's just blow that guy up for a minute on silver. Now, silver, if we said that the body of the candle is a measure of enthusiasm, well, I got to tell you, I think they were very enthusiastic here. They stopped and catch their breath. Day before yesterday, it looked pretty good. But what do you notice changing? Well, we see shadows on the top, which means people, if you go along with what I said earlier, it means people are selling that market. I mean, if you go to the top of that candle, right there where my little hand is, that was a green candle during its life. But it didn't finish that way yesterday. Is that a clue that something's changing? We go from buyers being dominant to buyers being less dominant. And does it mean we're going to have a big day down? No, it doesn't mean that. But it means that you and I are, for long, we got to be cautious. If we're looking for a place to sell it, this may be an opportunity. That's what it's showing us, I think. So very interesting, isn't it? Hey, let's check out copper. Then I should let you guys go. But what about copper? I mean, well, let's think about what I was saying about China. You know, things are softer there right now. And they, you know, consume about 50%. We don't have any supply issues right now. So this is what I call a false sense of security, by the way, that structure. This is normal. So far, we're not seeing precious metals responding to the news that we saw coming out. We're seeing the U.S. stock market weaker. We're seeing interest rates, the price of interest rates, yield curve going down. U.S. dollar stronger. I think I said that. Oh, let's talk about energy. In fact, you know, why don't we do this? I have a page set up here. Those are daily charts. These are monthly charts. And what we have here is gold, silver, and copper. And then at the bottom we have the S&P, we have the euro, and we have crude oil. So what do you think? Let your eye kind of, what is this general movement that we're seeing? Is it reasonable? I mean, gold was bearish last month. It looks like that daily we just saw in silver. Remember that one? It looks just like that. Well, kind of. But it's got that rejection at higher prices. Son of a gun. So maybe what we're seeing is the after effect of behavior that we saw last month. Silver called this an equal and opposite. It's the same as rejection. It implies a move down. And copper, well, copper needs China. Really. It needs strong manufacturing numbers. And we're not seeing it at this point. I am bullish on that market long term. S&P, we know it's a little bit softer today. This is, again, a monthly chart. And I'm looking for strength to come back to that, to all the stock indices tomorrow. I think we have a chance to see that. The euro, the dollar is stronger. But look how the euro, check this one out. Look how the euro is going lower. Is it going lower on these big red candles? No. It's going lower on shadows on the bottom. Son of a gun. They're buying the break here in the euro. But there's just no follow through. That's the challenge for that market. And for crude oil, you know, right now the U.S., if you think about what's happening with that, they're trying to squeeze another 20%, a decrease in the Iranian crude export. You know, right now some countries are given a pass to still buy some Iranian crude, China, India, for example. But right now they're saying, nope, that's over. But here's the deal. We have enough supply, just so you know, I feel. Again, this is obviously just my opinion, but I feel we have enough supply. In fact, this year we're going to have 3 pipelines coming online from the Permian Basin in West Texas and New Mexico, east side of New Mexico. That's going to add 3 million barrels of production to our production. We could be up to 15 million barrels. Saudi Arabia tops out basically at 12. Russia's up around there too. We're the only 3 countries that can produce that much. So this year is going to be interesting when it comes to this market. So this crude oil market that you and I are looking at, well, let's think about it in terms, whoops, I may have just moved up a little bit there. Hopefully you got that back. So if we think about these markets, I have them up here because they all go back to this metals. We know copper, we need to think about it in terms of manufacturing. Silver and gold, we need to think about it in excuse. And they are softer right now. So we could look for clues. If we're short, that's fine. If we're looking for clues to buy it, then let's see if we can find some levels where buyers may come back into that market. And, that would be the other piece that you and I would look at. And I'm just going back to the daily. This is the daily in copper. Are we going to find buyers where we found them before, which is around 288 to 287? Ooh, tomorrow's going to be interesting. Gosh, I wish we were together tomorrow because then we could see the attitude of the market as we go into the weekend. It's going to be interesting, isn't it? Well, I've kept you way beyond what I should be doing here. So let's get back here and go back to those slides. I think I can do that. Yeah, you should see a slide now. Well, thank you very much for sharing a good chunk of your afternoon with me. I hope you got some insights into where metals kind of fit in and some things to think about when you think about those products. I want to thank you for your questions. Any trading strategies for gold? We just went through those. The way I look at that, I look at that. Nyan, you also said, Dan, can you use on-balance volume on futures, or are they applicable only to stocks? No, you could use that. You know, in fact, you got a lot of different indicators to take a look at when it comes to TradeStation. So you want to take advantage of that too. Well, again, thank you everyone for sharing your afternoon with me, or depending on where you are. And Mike, thank you very much for your guidance today. Great to be with you as always. And I'm looking forward to our next webinar. And I want to thank the CME for making this possible too.
Thank you so much, Dan. It's always great to have you here. Thanks, everybody, for joining us. And definitely keep a look out on the TradeStation calendar for upcoming events. Join us tomorrow for Morning Market Briefing at 9 a.m. with Andrew Horowitz. Thanks, everybody. It's been great, Dan, having you here again, and we'll see you again on April 9th. Thanks, everybody. Have a great evening, and we'll see you again. Good luck in your trading.